Welcome, everyone. Appreciate you spending some time with us this beautiful Thursday. Getting some comments on my haircut, Justin, from the crowd.
I like it.
Let's get some disclaimers in here. Compliance loves that. Of course, our regulatory stuff is available on the SEC's website, as well as there's a link on our website. Investing involves risk. Information, this is for informational purposes only. And if you have any questions, talk individually about your situation. But again, appreciate you spending some time with us. This is one of Justin and I's favorite parts of the quarter because it really forces us to drill down on what specifically our views are, and to put them down in a format, obviously, that we can explain to others. So Justin, if you're ready, we'll get started. Today's themes we're going to go through is AI and leverage, two major driving factors right now of what's going on in the markets and the global economy. We're going to talk about inflation and energy. Again, lots of headlines, even recently, about both topics. Let's talk about the domestic economy and the new Fed chair. This is a big transition, if you will, with the Federal Reserve, with Kevin Warsh taking over as the chairman. And then finally, we go to happenings abroad. What we call is the tour. But let's go ahead and get started. So number one, AI and equity supply. This first chart looks at the semiconductor weight in the S&P 500 going back to 1995, so a little over 30 years. And as we see here, it's went up a lot.
Yeah, it's a remarkable chart. And, when you look at it, it kind of gives you a behavioral bias to think that, it's gone too far or it's somewhat unsustainable, which, it may be near term. And we're going to show some slides that might indicate that here shortly. But we also must remember the demand and the need for semiconductors of all types, of evolving types, is exponential. And I don't think anyone could say that's going to stop or slow down military and private sector use.
Yeah, and I mean so what is the implications is, your passive funds, your broad-based S&P 500 index funds are getting more concentrated in tech and specifically semiconductors, and be on the lookout for rebalancing. That it could be a nothing burger, but things could move really quickly a lot around quarter ends, when just these massive index funds rebalance their portfolios because semis have went up so much. So again, to Justin's point, it's a lot, but usage has also went up substantially. Next chart, we take a look at the semiconductor index's annual returns, and this is our one point: is semiconductors have become a much bigger component of the broader United States stock market and global stock market because of other countries we'll talk about later. But semiconductors are also very cyclical in that they're pretty volatile.
Yep, cyclical, and we'll talk ongoing about this, but maybe they're less cyclical than they used to be, which would explain this kind of sustained strong performance. But regardless of the outlook of semiconductors, with them being so much bigger in the index, we should all expect more index volatility over time.
Yeah, and just the gains have been explosive, but drawdowns can be brutal as well. And if you're thinking about chasing semiconductors here, just have a long-term time horizon, and be aware that things that go up really quickly can also go down really quickly. Next chart, again, this is something we've been talking about, writing about, is the dispersion of S&P 500 constituents. Has been all over the place. We've seen historical wild swings hitting the 99th percentile in February, and then the 0th percentile in April. So it's been all over the place under the surface of the index.
Yeah, that's a good point to clarify. So, for anyone who's just been looking at the indices, S&P 500 in particular, for the last 2 or 3 months, it's looked relatively calm, and more recently kind of as traded sideways near all-time highs, but under the surface, day to day, there's tremendous amount of volatility happening. It's just that not all stocks are moving in the same direction, up or down, which, collectively keeps volatility low.
Today's a perfect example, right? You've got healthcare up almost 3%, and then other sectors of the S&P down too, right? That's 5% different price return in one day, and that's this dispersion, this difference in the constituents' returns. It's been large, and what does that mean? Going back to our last chart, if you get over your skis, over allocated to the wrong areas, the S&P 500 could be ticking higher, and you're experiencing big drawdowns. So it's
And just that, let me add one more point, and we can leave this. You can go on to the next slide for this point because I think this is going to tie in. You think about the hedge fund community. So there's roughly, $3 trillion, give or take, that is in strategies where the manager needs to be long some stocks and short other stocks. And naturally, most of those longs are going to end up being long the things that are working because that naturally is just going to be the nature of it, right? I mean, they can't just continue to, they're not just there to buy dips and hold cash, right? They're in what's working. So you see these sort of like unwinds of positioning based on that. So that's a factor. And tying this into this next chart, you see that one particular levered ETF for semiconductors now has, what is that number? $35 billion market cap, which just simply means that every time the underlying semiconductor stock index moves, this ETF throughout the day needs to adjust and maintain that 3 times leverage, meaning that oftentimes what it's doing is it's buying at certain parts of the day when the market is up semiconductors and selling when the market is down. And we see that intraday in that several times this year there have been what looks like, breakdowns, so to say, and it's really just likely been flow dynamics coming from this.
Yeah, and I mean at 35 billion, that means it's controlling 105 billion of actual semiconductor shares, right? Because of the embedded leverage. So again, this is a nuance of the markets. They've made it easier to have embedded leverage, like institutional investors have been doing since the beginning of time, trading positions on leverage. So again, it's just something to be aware of. We're not making a call. We're just saying if the market goes through some big dips really quickly, take a look at semiconductors because they have a bigger impact and they've attracted a lot of capital, hot capital, that's trading on leverage, and leverage returns can move swiftly in both directions. Next charts looks at enterprise spending on large language models, the tokens, and it doubled in early 2026 and then has suffered a little bit of pullback before settling in here. And this is, a real time, I guess, health check on corporate AI adoption. How much are they actually using it in the corporate world?
This is an interesting chart. Thanks to Bloomberg for putting this out, but this is an index that, right, tracks the expenditure of so-called tokens from the major LLM models. And if you read a little bit about kind of like where Silicon Valley venture capital community, et cetera, is sort of evaluating these companies ongoing, these big, huge, richly valued private companies, in particular Anthropic and ChatGPT, we've reached a stage where the functionality of the models and the things that they can do are exponential, but the costs, crept up, which kind of recently seen here limited demand for tokens. But at the same time, big corporations are kind of in the, all right, we're using it, we're experimenting with it, but what traditional costs should we eradicate in favor of this, and how should we work this in? And that has created a bit of a pause in corporate America, a Fortune 1000 company adaptation.
Yeah, and I mean, what could it mean if it continues to slow or it plummets? That high demand for semiconductors could cool off, and you would logically see a shift from chip providers to companies successfully generating a return right on their AI implementation. So again, to be determined what happens here, but this is a a new input that we think bears watching. Uh, Along that AI theme is electricity. Electricity is a massive part with the data centers to power um, all of the computing power necessary to generate the AI. And what we see here is China versus the U.S. The U.S. has been going up. China started exploding on their electricity generation in 2022 and are anticipated to pass the United States in, I don't know, 2029 or so.
Yeah, this chart's pretty remarkable and just shows that, when the government gets fully and unequivocally behind a policy or a project, whether it be just general infrastructure or in this case, electricity generation build out, it's pretty remarkable. So the issue in the US is there's still so much debate at the state or regional and also the federal level around not only how to pay for the revamp of the grid, but really how to incentivize the private sector to actually start taking on these long duration projects that would, produce more electricity. Versus in China, they do a memo floated around the provinces and they get it done, don't they?
Yeah, it's happening.
Yeah.
There's no votes.
No,
Yeah, and I
but
mean that's why we're already seeing it, but you're going to see it even more as the nuclear fusion, new ways to produce energy in a much more efficient, cost-effective manner. I mean, I think this was moving even before the AI story, and it's just caught a lot more steam now. But getting viable products versus just companies selling a story, I mean, that's kind of where we are. There's a lot of these stories out there, but none of them necessarily have a viable product yet to start generating revenue. The a few weeks ago, anyone wanted to talk about was the SpaceX IPO, and it's come and gone, and now it's trading below its IPO price. There was a ton of money chasing it, and we tried to warn as many folks as possible just to wait a little bit, let it settle in. Not saying it's good or bad as a company, just be patient and give it some time, see where it settles in. And but going back, it was a historic offering, that IPO.
and historically, big offerings do come under pressure after that initial pop post
Which was
IPO.
kind of our point. Just be patient here.
Yeah. So, I mean, it's a hard company to have a real view on, but regardless of what one thinks, it's now in the indices or it's going to be in progressively more of the indices. So if you own the NASDAQ 100, you do in fact have a piece of SpaceX.
Yeah, and the point of showing this isn't to have a view on SpaceX. We don't. It's more the IPO and the timing of it. That it was extremely large. And going to our next slide, that's kind of been a reoccurring point of Justin and I this entire year is the overall market has been where companies are buying back shares, reducing the number of shares outstanding to even be purchased. And basic economics, supply and demand, if you bring down the supply and demand stays the same, prices go up, right? Well, we're pivoting to a new environment where that supply isn't going to be reduced, it's going to be increased. And that's what this chart does such a good job of showing the degree to which it's going to be increased.
And keep in mind that, 10, especially 15 years ago, a big IPO would have been $100 billion, right? Which you can see on this chart prior years, the bars were much smaller in terms of billion-dollar issuance. Versus now, these companies like SpaceX, like ChatGPT, like what we'll see with Anthropic, stay private longer so that when they do come out and do an IPO, such was the case in SpaceX, the amount of issuance that hits the market is much bigger than it was. So more supply, to your point, but we must also keep in mind that all sorts of different rules and regulations and societal norms are now in place that channel savings into the stock market and keep savings globally in the US stock market. So it's not as simple to say that just because you have this explosion of big IPOs, that's bearish, because back in 2000, the amount of money that would go into the stock market was obviously much less.
Moving on to our next section, inflation and energy. As we talked about, oil went up a lot around the Iran situation, and it didn't go up near as much as was predicted by a lot of experts. And it's, come down a lot since the memo of understanding on what the Iran-U.S. relations were going to look like that was signed in June.
And this chart, is, I guess, as of last week. So oil has now bounced back up, I believe just a bit over 80 today. So off the lows on this chart, but still well below what were the prior highs. And, that's simply on headlines that I think the market and really everyone in the world is kind of starting to realize that although the situation with Iran likely won't be the worst case that was initially thought in terms of rising oil prices and, slowing economic activity sharply, it also may not completely go away. So the market is currently figuring that out, but the oil market is notably not afraid, let's say.
Yeah, and I mean, applying this to investors, this next slide, some would say, well, okay, the energy sector would be, maybe we want to avoid it here. Well, counter to that is maybe not, because of this slide, that there could be substantial demand from the U.S. government to refill the strategic reserve of oil because it was drained substantially to a level not seen since the early 80s.
I would say we probably agree there is no better way and reason to use a government strategic oil reserves versus what they've done recently, which is sell them into the market, at high oil prices and buffer what was the pretty sharp, perceived supply shock with the situation in Iran. So I think the point being is that eventually they're going to have to refill them, most likely, albeit they could probably run these levels longer if they needed to. There's no real urgency to do that, but it does make this lever less likely or impossible to pull if, in fact, oil prices start going up again. So this was a buffer that in the near term won't be able to be duplicated twice in short order.
Next slide looks at PCE, PCE core, a measure of inflation. And it's ticked up, and then most recently measures of inflation came in lower than expected. And it didn't get back to the levels that were expected by the Federal Reserve. It has stayed elevated, but as we've discussed, has the market repriced that tolerate a higher level of inflation overhanging global economy.
So similar to oil, this kind of looks like it in some ways. Now, this is going back to the highs of 2022, but that would even kind of look like oil. So despite the fact that this is stripped out energy, this is core, it does just go to show how if one just sort of follows the big picture trend or theme of energy, you're going to kind of have a good grasp of, where inflation is going. So the two are connected, but for now, the market has gone from expecting rate cuts this year to potentially expecting rate hikes. So to our ongoing theme of there's news or there's an input, but we need to think about what the market has already priced. Everything we're showing here is in the market, so to speak. So the question is how does this evolve?
Yeah, and I mean this is another inflation input is consumer spending, and I mean the consumer refuses to quit despite the higher inflation numbers. The consumer spending has been strong.
Which to the wealth effect that we talk about, right?
Yeah.
This measure would be driven disproportionately by a smaller percentage of the total population, and that percentage of the population, are either close to or in retirement and have, what has grown to be historically large stock and bond portfolios, if not also the ability to, borrow against their home and go out and spend.
Next section, interest rates and the new Fed chair. There he is, the Stepford Fed chair, Kevin Warsh. And this first chart looks at the 2-year yield, which most closely reflects market's anticipation of what the Federal Reserve is going to do. And it's been wild here lately.
Yeah. People often think, that don't follow the market kind of day to day professionally, that, 2-year bonds are stable. And, they are. If you hold them to maturity, you're going to get the yield that you promised. And it's considered to be a very safe asset. But, if you're just looking at the fluctuation of those yields, you can see here that the news flow has really kind of been everything. So, and again, thus far, the trend is nowhere.
Yeah, it's been range bound. Take a look at this next chart. We showed this on our last chart overload. It's such a big input into why we think there could be a little bit of a nothing burger from some of the negative headlines that are out there.
Yeah, so this is basically showing 2-year yields minus the current Fed funds policy rate. So as you can see, 2-year yields are now above the Fed funds rate, which just simply means that the market looking out 2 years is already priced rate hikes. And if in fact that doesn't happen, or it shifts and there ends up being rate cuts between now and 2 years, you are not only going to get paid the yield in your bonds, but you're going to make principal appreciation as that comes back into balance. And, typically the only time you see a sustained either way in this is what's going on with inflation and obviously what's going on with the outlook for monetary policy. So anytime this is positive, such that it is now, you can just say that by and large, 2-year bonds are relatively more attractive than they were, assuming they're already pricing interest rate cuts.
And it's back to what you said, what's in the price, right? There's a lot of rate hikes already in the price of the 2-year. And if they don't come to pass, then naturally 2-year yields would be expected to come down, and it could come down quickly. As we saw on the last slide, right? They've been volatile, but they could continue to be. Next chart looks at the market's anticipation of what the Federal Reserve is going to do. And this has, again, been all over the place, which, goes into even our next chart, that they've been all over the place, and it seems like a lot, but historically they're always all over the place on the market's response mechanism to the Fed.
Yeah, and this just shows in a different way that, whether you look out September, October, December, January, March, not only are there no rate cuts priced anymore, which there were several earlier in the year expected, now you're looking at, the market sees it to be 100% probable that by January, if not December, there's been at least one 25 basis point rate hike or more.
Next chart, again, shows the median expected Fed policy rate, and then the market's pricing of it. And again, it seems like a lot because it's happening now, but looking at history, they've always been all over the place.
Yeah, been all over the place. And even though they move a lot, you can kind of just take a look at this chart and see that they are generally directionally right over, a multi-year period of time, right? In that it can be early, but you see going back to 2013, 14, the market expected rate hikes to occur well before they did, but ultimately there were no more cuts and the hikes did happen. And then the recent lowering of interest rates that started back in roughly 2023, the same has been true. So we're now in a situation where we're potentially in a transition, and the big question is how long will the market continue to intensify its expectation for rate hikes, or will that in fact go back and this is a rate cut cycle? So it's very much live with the new Fed chair.
Next chart. This is showing RAM prices, a component of hardware, computer hardware, and what has been historically more on the deflationary side. This could be a additive to the consumer price index moving forward.
Yeah, it's just a source of inflation that you could see going back prior to this recent run higher was actually a source of deflation. So how long this lasts in terms of it applying into new vehicles, it's to be determined. But this could be an inflationary source that might be here to stay. But we must caveat that this source of inflation is also the earnings source for many of the semiconductor stocks.
Right. Yeah, and what does it mean outside of the semis is companies that are really dependent on buying hardware components, could see their margins squeezed in the time it takes them to buy their hardware and then pass on the prices to consumers, right?
Yeah. So if a consumer is paying more for new vehicles or telephones, for example, based on this chart, they are paying more to whomever they're buying the car or the telephone from, but that company has been paying a lot more to
uh,
Nvidia, Micron, SK Hynix, and so on.
we're getting to the end of this section. There's a Q&A button. If you do have a question, click that and fire it away to us. We'll take some questions at the end, like we always do. Next chart looks at cooling inflation expectations. 10-year real yields are climbing while the market's break-even rate's going lower. And what could be some takeaways from this? The market believes the Fed will have some success fighting inflation, or inflation will come down naturally. But there is a bit of a disconnect here.
Yeah, and you could say the disconnect is just that based on market pricing, there is no visible worry of long-term runaway inflation, right? And one could easily argue that one of the reasons the new Fed chair has come out with a strong rhetoric about stopping inflation is to ultimately make sure that these long-term inflation expectations, in this case, the break-even rate, don't start to, get life to the upside. So for the moment, we're in a situation where not only are bond yields higher, but the so-called real interest rates, those bond yields relative to inflation and future inflation expectations are actually high. So in the old days, this would be a kind of a classic environment where at large, there would be a lot of selling of stocks and buying of bonds.
Yeah, because it puts absolutely. That's exactly what I was going to say. It structurally caps the multiples, right? The multiple people are willing to pay per dollar of earnings, and we haven't seen that happen. And why? Because I guess back to what Justin said earlier, it's in the price. They're anticipating inflation to come down, and with it, real yields.
Yeah, it's in the price, and I think we should all be open-minded too that, what we're referring to here is the so-called, Fed model, which is basically meaning that there's a portfolio transmission mechanism where, to your point, Ryan, once real interest rates get high enough, whatever that is during that cycle, it then not only slows down earnings growth because of the higher cost of capital, but those yields compete in terms of, offering people something versus the stock market. And historically, that has been the framework. But now the cultural zeitgeist, let's call it, of stocks is just much stronger. Not to mention people that own stocks own much more of them, which just simply means that, a lot of people are just kind of willing to not rebalance and just let their stocks run, which,
YOLO.
love.
Just ride it, ride it with leverage now.
Right.
Moving into our next section, our final section, happening to Broad AK, the tour, where we cover things outside of the U.S. and commodities. Again, the Q&A button at the bottom. If you have a question, type it out, and we'll get to it at the end of the section. First chart looks at I always say this is the US dollar, and people have piled into betting it will strengthen. And this is, in my entire 25-year career, one of the reoccurring themes is the demise of the dollar. And that just, hasn't happened yet. And it certainly hasn't happened recently. Because for several months now, the dollar has shown tremendous strength. And people are betting on it.
Yeah. What's big picture, what's interesting to kind of go off of your point is if you follow, popular media or financial market newsletters or whatever, there's this constant narrative of inevitable dollar crash and dollar decline. But in the last, call it 7 or 8 years, and I know we've talked about this, Ryan, there's also a constant narrative of runaway dollar strength, or they call it the dollar wrecking ball. So what really happens with currencies, it depends on the current one currency versus the other. And then the dollar trades on kind of, broad regimes, which is largely based on US interest rates relative to interest rates elsewhere. And, the rate of change in economic activity or capital flows to US stocks and US assets relative to elsewhere. And then obviously, if there's a big deficit, there's more dollars, right? But what we're showing here is that speculators in the market, when certain events or things happen, will often get long the dollar, such as that they've had recently. But all the other underlying dynamics that are at play with the dollar regarding interest rates versus other currencies, et cetera, hasn't really changed, which is why if you look at this chart, you'll see so-called speculators in the dollar simply oscillate from long and short, over time, because that's just the mandate of what participants do in currency markets, right?
And why does it matter in this global economy? A dominant dollar dilutes the, foreign earned revenues for large U.S. multinationals. It puts pressure on emerging markets. It puts pressure on foreign countries holding dollar denominated. Again, it just it is, to Justin's point, it can be the wrecking ball, which is the opposite of the popular narrative that the dollar's going away. Next chart, this just looks at the South Korean stock market, which, as we've discussed, is heavy in the semiconductor space, and it's, I think Justin said parabolic earlier. It's been parabolic.
So SK Hynix, Samsung are basically, I think we put a chart on this in our last weekly update, but they're effectively over two companies, 50%, over 50% of the Korean stock market, which, these are the dominant companies selling memory chips. So while NVIDIA is selling more specialized stuff, ASML is selling machines to make semiconductors. These companies in South Korea, along with, Micron, are selling what used to be the most cyclical part, because memory chips would basically kind of go in and out of demand based on, electronics, et cetera, versus now you need them for AI model training, U.S. government defense AI deployment, so on and so forth. So Korea is a beneficiary, and they are actually taking a lot of the money and channeling it back into their stock market.
Yeah. And, sticking in that region of the world, we just looked at South Korea. Now look at, China's internet component, as measured by the US ETF KWEB. It's been in a drawn out drawdown, downtrend for some time here.
Which the narrative on that would be that the big Chinese tech companies aren't really benefiting from AI as much as they're having to pay into it to try to do it. And China is unleashing a lot of what they're calling open source language models, where unlike ChatGPT or Anthropic, that is kind of like a closed ecosystem provided by that company, the Chinese models, you have to tweak and add and construct on top of them. But basically, hypothetically, a company could just download them and build a miniature LLM specific for them doing whatever, and they wouldn't need to, to pay Anthropic or ChatGPT and risk the fact that Anthropic and ChatGPT might try to steal their business altogether. So it's a complicated dynamic, no doubt.
Um, this looks at average daily production in the LATAM for oil. And this, is maybe part of the input. Why did closing of the Strait of Hormuz not impact the global oil markets and the broader global economy as much as it did? Because there's new sources of supply. That's, much more than it has been in the past.
Yeah, and people often talk about, the epic decline of Venezuelan oil production, which you can see here to be the orange line. This goes back to the 1970s. Or people often talk about the fact that Mexican oil production really peaked in the early 80s, then again in the 2000s, and has been on a downcline, or a downtrend ever since. But the purplish line here, fuchsia, I think is that color, shows Brazil, right? People don't really appreciate the fact that Brazil has grown oil output tremendously in a straight line upward and is now producing far more than any other country in Latin America at above 3 million barrels a day. So that's really helped to cushion the shock in energy prices coming from the Middle East.
Next slide looks at global real policy rates compared, and central bank approaches are obviously much different across the world.
So back to what we were talking about in terms of this being important for kind of the dollar being different versus different currencies and so on and so forth, different global, I guess, regimes, you could call it. This is taking what is the current policy interest rate. So in the case of the US Fed funds, and it's just simply subtracting the most recent CPI, which is inflation number that, has popped of late due to oil prices. And it just goes to show that the U.S., at present is a bit negative in this most recent reading. You've got other countries that have real interest rates, around 1 or 2%. And then if you go down to the bottom, you've basically got Brazil that's got real interest rates of close to 10%. So we are very much segregating our view of different countries based on, are they countries where the interest rate differential, which we're looking at here, real interest rate matters? Or are they countries like, say, Korea, for example, which are reliant on some sort of corporate earnings story or secular trend to continue to do well? Because looking outside the US, on the tour here, not all countries are created equal, which is easy to say, but it's very important to appreciate the nuance of that.
Last slide, looking at the Iran war, the higher oil prices, and what it's done to various countries on the global growth scale. And these are the flash PMIs of manufacturing and services, showing that some all countries got hit, but some got hit, except much harder than others.
Yeah, services in Europe, in particular, got hit really hard by rising fuel prices, as that just kind of manifested there quicker. And people there in general have less access to credit in some sense, and just overall less wages than in the U.S. to kind of absorb it. So but on the flip side, you've seen the European stock market actually do pretty well for the last couple months as the market has started to price out the worst case worry over the rise in oil prices to kind of our prior point. So back to kind of differentiating when you look at different global jurisdictions, in addition to looking at what is the growth engine of the economy, what is the interest rate dynamic, it's also important to look at what is the sensitivity to oil prices, and that some countries seen here, like Europe, are hurt by higher oil prices. And then to the prior slide, there are going to be some countries that to a certain extent are going to benefit.
Yeah, and the market, this is lagging data, and the market almost always front runs it. And to Justin's point, these countries that went down the most, the quickest, has seen their stock markets go up the most, the quickest, on the other side of that memo of understanding between the U.S. and Iran, and it's back to what's in the price. Oftentimes this is lagging data, and it's already well documented in the price. The question is, how long will it continue, on whether you want to make some investment allocations to those areas. We're on to the Q&A. Again, the Q&A button at the bottom of your screen. If you want to click it and send us a message. I got one now, Justin. Earnings have bolstered the market so far this year. What do we anticipate for the upcoming session? I mean, I would say that earnings revisions tend to follow the same pattern. They get raised ahead of time, and then closer to it they come down, and that's what we've seen. What's in the price. There's already an anticipation that earnings won't be what was once expected, even just a few months ago. But I always take it to the bottom line. Why do we invest? We invest to participate in the profits of the companies, of the shares we own. What do you got on that, Justin?
So 2 points on earnings, I think, that are super important to think about is, number one, if you're talking about earnings across the whole stock market, over time, aggregate corporate earnings go up at least the amount of inflation, right? Which is why stocks have upward drift over time, assuming money gets channeled that way. So there's that. And a lot of companies do have pricing power, which you can sort of look at that through some of the indicators we've showed, and many more. Second point is that if you just look back over the past 15 years, except for a couple different clusters of quarters, I think 2022, there was another brief period of time, I believe it was 2 or 3 quarters in 2015, and then obviously the shock we had of COVID. All the rest of the time, every single time, what the market does is it ratchets down expectations for earnings, making it easier for companies to then at least meet or beat earnings. Because again, we must realize the entire system is engineered for earnings to go up, at least inflation, if not more in aggregate, and companies to continue to be able to project, show, and give confidence in earnings growth. So we think that earnings will likely be very volatile for the semiconductor stocks. So we're kind of staying away from any sort of isolated exposure to that, even though we do believe that there may still be a longer term growth trend there. It's just very volatile. But we think what's going to be most important is how the market reacts to the earnings of the big mega cap companies that are not semiconductors. So Amazon, Microsoft, Meta, Google. And the reason being is that those companies are driving GDP with their AI CapEx expenditure. And the degree to which they can do that is the degree to which the market welcomes their earnings release and their forward guidance. So we're going to be watching that closely.
We've run out of time. Appreciate everyone tuning in, spending some time with us today. We know you could spend your time a lot of different places. We appreciate you spending it with us. We'll be back next quarter with the path forward, and then in 2 weeks, every 2 weeks, we continue to drop our chart overload series on our YouTube channel. But I hope everyone has a great end of the week and weekend. We'll see you next time.